Hi there, welcome to Neppy Invest. Interesting episode I have for you today. I'm hoping you find it interesting. So, in this episode, I'm going to completely disagree with someone I actually quite respect quite highly, and I think very highly of this person. Now, I listen to podcasts, read articles, ASX announcements. I'm even starting to watch Ausbiz, the core segment, every single day. And the whole reason I'm doing that is to garner ideas. And in fact, the whole reason I'm doing this Yahoo business channel, finance channel, is to share ideas with you. And I think sharing ideas is the most powerful thing we can do as people, as humans, because if I can share you one idea and that idea can inspire someone to do some further research, buy into that company, and that company becomes a huge multi-bagger over the next 10 years, I have done a good thing. Now, most of the ideas I do share with you, I won't follow through with myself. In fact, very few I do. But I was listening to a podcast the other day, a podcast I listen to every single episode. I quite like this podcast. I think it does give me some ideas. And the two guys on it's two people who do this podcast. The two guys on it, I particularly like one guy. Now, this guy is more in the sort of the tech space, the growth space. That's where his ideas do give me some scope to challenge, to research, to inspire. Now, the other day, I was listening to this one podcast, and they started talking about CSL because the question, a listener gave them was, can CSL be considered a growth stock anymore? And this one guy I really respect started to bag on CSL like nothing else. He started talking about this is not a world-class company. It's an overrated company by the Australian community, overvalued. And the main reason behind all that was because the company had no cash flow growth. Now, instantly, I thought this was complete and utter BS. And the reason I know it's complete and utter BS is because I did a little bit of work on this company in the past. Now, I do think the valuation of CSL is quite rich, but it's been rich for at least 10 years or so. And the reason it's quite rich is because people have to pay a premium because this is a world-class company. So in this episode, what I'm going to do is to show you proof while this assertion that CSL has no cash flow growth is complete and utter BS. So the thesis I'll be challenging today, CSL is overrated or overvalued because it has no cash flow growth. So the first thing I have to mention here is what do we mean by cash flow? So there's a couple of different sort of metrics we can be looking at. We can be looking at free cash flow or operating cash flow. And I know the analysis or the expert in this point or this case was actually referring to free cash flow. So that's the first thing we really have to look at. So before I get into the point of this slide, I just want to talk about fake news. Now, the main generator of fake news isn't media, isn't journalists, it's you and me. It's the normal person out there. We're way too quick to believe anything we read on social media or anything we hear. We're just way too quick to accept that. So I think it's very important to challenge assertions that I've made. So when this person said this company has no cash flow growth, a lot of people just would have simply believed that. So I think it's very valuable whenever you hear something to just question, just don't accept it on face value, just question it, and maybe you can actually challenge that assertion. So what I've done here is I've gone back 15 years or so and looked at the free cash flow of CSL going back those 15 years. And we definitely can see a bit of growth here going back to 2006. In fact, it's been growing at a compound annual growth rate of 11% per year. Now, you can go back the last 10 years and 5 years, it's still been growing. But there is some way you could distort this information, say has been growing since 2015. In fact, in 2015, free cash flow for CSL was 1,237, and in 2019 it was 530. So if you take those 2 points in time, you would say the free cash flow of CSL is going backwards. This company is dying. That's that sort of thing you can make by just taking two arbitrary points that suit your argument and using that and saying CSL is a dying company because free cash flow between 2015 and 2019 has halved. And you can just see here the free cash flow of CSL is quite lumpy. And there's actually a fairly good reason behind that, which I'll get into in the next few slides. So it's very important here to distinguish what we mean by free cash flow and operating cash flow. There is a big difference between the two. And when someone's talking about cash flow or cash flow growth, what do they mean? Are they talking about free cash flow growth, or are they talking about operating cash flow? Now, personally, I like to focus mostly on the operating cash flow, but I think it's very important to understand the difference here. And the main difference between the two is that free cash flow is operating cash flow minus the capital expenditure. And capital expenditure for a business is very important. There are some companies that spend a lot more capital expenditure than other business, and to know why is very important. So capital expenditure can be broken down into two components, two fairly important components, and that is maintenance and growth. And I would love if every business, every company in the world breaks down their capital expenditure to these components. Unfortunately, most businesses don't, but CSL does. And why is it important? Well, simply enough, maintenance is simply the money a company spends to maintain that day-to-day running of the company. Growth, on the other hand, is money spent to grow the company. So you can think of the old saying, spend money to make money. That is capital expenditure that is being used to grow the company. And I think that's a very important distinguish to be made between maintenance and growth. Maintenance is just simply to maintain the day-to-day running of the company. Growth is used or spent to grow the company into the future. So in this graph, what I've done is I looked at the free cash flow, and now I've included capital expenditure of CSL. And the one important thing here, you can see capital expenditure over the last about 6 or 7 years has grown quite considerably. So in fact, since 2006, capital expenditure has been growing at about 22% per year for CSL, and over the last 5 years actually been growing at 30% per year. So CSL is spending more money on capital expenditure. Now, in isolation, that means nothing. So have they been spending the money on maintenance or growth? That's the most important thing here. Is CSL spending money to grow for the future? Now, even though we don't have all the information about operating cash flow yet, we can actually defer some information from just looking at free cash flow and capital expenditure. So we know free cash flow is actually growing slowly, but capital expenditure is growing quickly. So simple fact is, because free cash flow is simply operating cash flow minus capital expenditure, by simple mathematics, we know that at this point in time, operating cash flow must be growing quickly because CSL is spending more and more money on capital expenditure. So this is a graph I actually produced about 3 or 4 months ago, and this is something I always look at for most companies: revenue, profit, and operating cash flow. And you can see just by this graph that the revenue is growing quite quickly for CSL over the past say 10 years or so. And even though you can't really see it here, but profit and operating cash flow have been growing quite strongly as well. So in this graph, I just decided to take away the revenue so you can look at the profit and operating cash flow growth in a much simpler way. And you can see without doubt the profit and operating cash flow have been growing. In fact, you can see the numbers here with profit and operating cash flow. They're very similar. So you can see most of their operating cash flow is going to the bottom line or in profit. So impressive growth here when you look at CSL in terms of their profit and operating cash flow. So the whole thesis that CSL isn't growing their cash flow, I think, is quite dead here at the moment. So in this table, I've just looked at the compound annual growth rate of revenue, profit, operating cash flow, and the share price. So the main thing here is looking at the growth rate of operating cash flow over a different time periods for CSL. And you can actually see over the past 3 and 5 years, the operating cash flow is growing stronger. Now, there is one thesis I do have, and that is when you look at the operating cash flow growth and compare it to the share price, you can actually tell if a growth company is overvalued or undervalued. So if the operating cash flow is growing at a slower rate than the share price growth, that would suggest the company is overvalued. So if you look at the last 15 years, operating cash flow has been growing at about 15% per year, but the share price has been growing at 22%. But over the last 3 years, it's actually been flipped. In fact, operating cash flow has been growing at a stronger rate, while share price growth has actually pulled back a bit. So right now, CSL is actually more undervalued than it was 3 years ago. Now, I've talked about this before. It's important to know whether CSL or any company is spending their capital expenditure for maintenance reasons or growth reasons. Now, fortunately, CSL does give us some information in regards to this. Not all companies do this. So this is taken from their annual financial year 20 presentation. They've broken down their maintenance, the capital expenditure for maintenance and growth into this nice little table. And you can see how capital expenditure has been growing. You can see actually maintenance expenditure has been leveling off. It's going sideways. So most of the increase in capital expenditure is being spent for growth reasons with CSL. So that's very important to know here, that the increase in capital expenditure is for growth reasons, not maintenance reasons. So what does all this tell us about CSL? And these are very important things to know about the company. CSL is pumping their cash they create in operations into growing their business for the future. Now, I look back at Amazon going back about 10 years ago, and when you looked at their free cash flow growth, it was flat as well, because they were pumping all their cash they were generating from their business into growing their company for the future, and that has succeeded very well. So it doesn't mean just because CSL is pumping a lot of their cash into growth initiatives, doesn't mean it will be completely successful like Amazon. But CSL is a growth company. This is sort of the definition of a growth company. When you compare to other, ASX 100 companies, those companies are not growth companies, because when you look at the payout ratios when it comes to dividends, most of those companies, almost have a payout ratio of approaching 100, which means all the money they make, they give back as dividends, which means they are not growth companies. They are not spending their money for growth. They are just spending the money to remain at a constant level. And this is a very important distinguishing thing to make about Australia at the point. Now, dividends suppresses innovation and growth. That's a very important thing to know. I'll repeat that. Dividends suppress innovation and growth. And that's a big problem Australia is facing right now. And CSL is bucking that trend. It's saying, I'll rather spend the money we make in business to grow for the future. And that's why CSL will more than likely be a much bigger company in the future. So the assertion, the thesis that CSL is not a growth company, that has no cash flow growth, is wrong and utter BS. So that's all for this video of CSL and why I think the assertion or the thesis that CSL is no longer a growth stock, it's not a world-class asset and is not growing that cash flow is wrong. Now, you could have a different opinion than mine and think I'm completely wrong, and I would love it if you leave a comment in the comment section, because I think it's highly valuable to look at different opinions and take those different opinions on board and to assess them. I think that's the only way you can learn and grow as an investor, not only as an investor, as a human being. So in saying that, that's all for this video. Again, I'm not a financial advisor, so if you do need financial advice for your own circumstances, make sure you seek out someone who is qualified and can speak to your own financial needs. Have a good day. Talk to you later. Bye.